There are two types of people who enter the stock market. Both open a brokerage account. Both buy stocks. Both check prices. From the outside, they look identical, but they are playing completely different games, with completely different rules and completely different outcomes. Most people never realize which game they're actually in until it's too late. Meet Nate. Nate is 28. He's been watching finance content for 6 months, and he's convinced he's ready. He opens a brokerage account, deposits $5,000, and sits down in front of his screen. He's heard stories, people turning small accounts into life-changing money in weeks. He wants in. What Nate is about to do is called trading. Trading, at its core, sounds simple. Buy low, sell high. Do it fast, do it repeatedly. A trader doesn't care if a company makes great products, doesn't care if the CEO is brilliant, doesn't care if the business will exist in 10 years. All the trader cares about is one thing. Where is this price going in the next few hours, days, or weeks? To answer that question, traders use technical analysis, the practice of studying price charts, identifying historical patterns, and using those patterns to predict future price movements. The core belief is straightforward. Markets are driven by human emotion, and because human emotion is repetitive, price patterns tend to repeat too. Nate spends 2 weeks studying charts. He learns candlesticks, support levels, resistance levels, trend lines. He feels prepared. He picks a stock trading at $40. His analysis tells him the price has hit a support level. Historically, every time it drops here, it bounces back. He buys 50 shares. $2,000 in. The stock drops to $33. Nate stares at the screen. He holds because he's certain he's right. It drops to $30. He's down $500. The pain becomes unbearable. He sells. 3 days later, the stock bounces back to $42. This is trading. Not the highlight reel version, the real version. Here's what's important to understand. Trading is not gambling. Done correctly, it is a legitimate skill. Professional traders manage risk with precision. They never risk more than 1 to 2% of their capital on a single trade. They have predefined entry points, exit points, and stop losses before placing a single order. But trading demands everything from you: constant attention, emotional discipline, relentless focus. It is not passive. It is not a shortcut. It is a full-time profession, and the market will expose anyone who treats it as anything less. Nate eventually figured that out. It cost him time and money to get there. Now, meet Victor. Victor is 34. He works in operations at a mid-sized company, earns a solid income, and has been quietly putting money aside for years. He has $22,300 ready to invest, and he's in no rush. Victor is not interested in charts. He is not interested in price movements. What he wants is a system that builds wealth in the background without demanding his constant attention. What Victor is about to do is called investing, and the difference starts before he buys a single share. Where Nate looked at price charts, Victor looks at businesses. Investing is not about predicting where a price moves next week. It is about identifying a company that will be worth significantly more in 5, 10, or 20 years, and buying ownership in it today. The tool Victor uses is called fundamental analysis. Fundamental analysis means reading a company like a business owner. Victor looks at revenue. Is the company actually growing? Profit margins. How much stays after expenses? Debt levels, earnings per share, return on equity, competitive positioning, management track record. He is not asking where the price will go tomorrow. He is asking a completely different question. Is this a great business, available at a reasonable price? Victor finds a consumer brand he believes in. Strong earnings growth, low debt, a defensible market position, consistent management. The stock is trading at $45 per share. Victor buys 200 shares, $9,000 in. The next month, the broader market pulls back. The stock drops to $40, then $38. Most people panic at this point. They watch the number go down, and their instinct screams, "Sell before it gets worse." But Victor doesn't see a falling price. He sees a business he already analyzed, and that business hasn't changed. The latest earnings report shows revenue up 18%, margins expanding. Management just announced a share buyback, a signal that even the company itself believes the stock is undervalued. So Victor does something that feels deeply uncomfortable, but is fundamentally correct. He buys more. 350 additional shares at $38. Another $13,300 deployed. Total invested, $22,300. Total shares, 550. Average cost per share, $40.54. This is what separates serious investors from everyone else. When a great business goes on sale, you don't run away from it. You buy more of it. 5 years pass. Victor didn't watch the price daily. He checked in quarterly, read the earnings reports, confirmed the fundamentals were intact, and got on with his life. Some quarters the stock was up. Some quarters it was down. He didn't react to either. Year 5. The stock is trading at $112 per share. 550 shares times $112 equals $61,600. Victor's $22,300 investment is now worth $61,600. Profit on shares alone, $39,300. But that's not the full picture. The company paid dividends throughout, $1.80 per share annually. 550 shares, 5 years. Dividend income, $4,950. Total return, $44,250 on $22,300 invested. Not because Victor was lucky, not because he predicted the market correctly, because he identified a great business, bought it at a fair price, added more when it went on sale, and had the discipline to hold while the business did what great businesses do: compound value over time. This is the mechanism that the most successful wealth builders in history have used. Warren Buffett has held Coca-Cola stock since 1988. Not because the price never dropped. It dropped many times. He held because the business remained exceptional. His net worth didn't come from predicting short-term price movements. It came from owning great businesses for extraordinarily long periods of time. The U.S. stock market has returned an average of approximately 10% annually over the long term, through recessions, wars, crashes, and crises. An investor who bought consistently and held has historically outperformed the vast majority of active traders over any 10-year period. That is not an accident. That is the math of compounding working exactly as it should. So where does that leave Nate? After 1 year of trading, wins, losses, stress, screen time, Nate was up $800 on his original $5,000. A 16% return that cost him hundreds of hours and an enormous amount of psychological energy. Victor, 5 years in, nearly tripled his money, without watching a single chart, without a single sleepless night over a price movement, without missing a single day of his actual life. This is not a condemnation of trading. Professional traders exist who generate extraordinary results, but they are operating at the highest level of a brutally competitive field, and they will be the first to tell you it is not for everyone. Investing, by contrast, does not require you to be extraordinary. It requires you to be patient, disciplined, and honest about what you are actually trying to build. The market rewards both, but on completely different timelines with completely different demands. Most people enter the market looking for speed. They want results now. They want the account to grow this week, this month, this year. But the people who actually build wealth, they enter the market looking for time. They understand that the most powerful force in investing is not intelligence, not timing, not prediction. It is simply staying in the game long enough for compounding to do what it does. Victor understood that from day one. Now, so do you. If this changed how you think about money, subscribe, because this is just the foundation.